Imagine a company doubling its revenue in just 9 months, but burning through over $1 billion in cold hard cash to actually pull it off. Sounds like a paradox, right? I mean, is this a visionary tech giant literally building the future, or just a financial house of cards waiting to topple? Welcome to the EDGAR Brief. Today, we're cracking open the latest 10Q filing from Applied Digital, ticker symbol APLD, filed for the quarter ending February 2024. We're going to translate this incredibly dense accountant-speak document into plain English. Quick note before we jump in. We're an independent explainer. We aren't affiliated with the SEC, and we're definitely not financial advisors. We also use AI to help summarize these massive filings, so errors can happen. Always verify the numbers on sec.gov before making any actual money decisions.
All right, let's lay out our roadmap. We're going to hit the business model, run through the financial scorecard, check their competitive moat, dig up the red flags, and then give you the absolute bottom line.
Okay, Section 1, the business model.
Our main goal here is to just follow the money. Profit can be manipulated with accounting magic, but cash is real. So to figure out how cash moves in and out of Applied Digital, we have to ask a foundational question. What exactly do they sell and who's buying it? The filing says they provide energized space to tech companies for AI, cloud, and blockchain workloads. But what does that actually mean in the real world?
Well, they call it high-performance compute, or HPC hosting. But in plain English, think of them as a mega landlord for the AI gold rush. Seriously, they build the massive physical data center facilities and supply the heavy-duty electricity. The tech company, the tenant, brings their own servers and just plugs them in. So the money comes in through long-term leases where customers pay a fixed rate for that space and power. It's exactly like paying rent for an apartment, just on a gargantuan high-tech scale.
Moving on to Section 2, the financial scorecard.
Let's see if this mega landlord strategy is actually putting real money in the bank. Now, the absolute velocity of these numbers is wild. Look at the 9-month scorecard. Revenue exploded to $352 million, up from $175 million in the exact same period last year. That is over 100% growth. So yes, way more dollars are walking in the door. But hold on, look at the operating loss. A loss of $111.6 million. This tells us that from their actual core business, before any fancy financing tricks, they lost significantly more money than the $28 million they lost last year. And to fund all this explosive growth, they're sitting on a massive $2.59 billion in long-term debt, which is buffered by about $2.1 billion in cash and restricted cash.
So we're looking at this incredible contrast, right? Massive revenue growth on one hand, versus an astronomical cash burn on the other. If we strip away the noise and just look at their day-to-day operations, the cash actually generated from doing their job as a landlord, it was negative $42.8 million for those 9 months. The business itself isn't producing cash yet. It is purely consuming it.
But that's just the day-to-day stuff. Check out this number. Negative $1.59 billion in investing cash outflow. Like a sprinting hare, they are just incinerating real cash right now. And where exactly is it all going? Almost entirely to purchases of property and equipment. They are aggressively, frantically building out physical infrastructure.
Ultimately, the crucial point here is simply that growth is expensive. When you take on over $2.5 billion in debt to fund the construction of massive data centers, it leaves almost zero margin of safety. Think about it. If the AI hype cooled and revenue stopped tomorrow, the lights would go out pretty quickly under the crushing weight of that debt.
Section 3, let's do the moat check. If this AI real estate market is so incredibly lucrative, what's stopping competitors from jumping in and crushing Applied Digital tomorrow? Well, their protective moat isn't some secret software patent. It basically comes down to 2 highly durable advantages: massive physical scale and guaranteed access to electricity. And let me tell you, in the AI world, power is the ultimate bottleneck.
This perfectly illustrates their biggest weapon. A 1.2 gigawatt power generation facility located in the Midwest, which is currently being designed and built. To put that completely wild number into perspective, 1.2 gigawatts is roughly the power output of a nuclear reactor. Securing that kind of clearance from the grid and building out the infrastructure literally takes years. A competitor absolutely cannot just match that power supply overnight.
All right, Section 4, management's discussion and red flags.
Time to read between the lines and uncover what the corporate lawyers have buried in the fine print. And honestly, this is the single biggest red flag in the entire filing. Look at their customer concentration. Customer A makes up 52% of their revenue. Customer B is 33%. Customer C is 15%. Do the math on that. That is exactly 100% of their revenue coming from just 3 tenants. Imagine owning a billion-dollar apartment building, but you only have 3 giant tenants living inside. If even one of them decides to break their lease or goes bust, it's not a bump in the road. It is an immediate existential crisis for the company.
We also found this little quote tucked away in the notes, a $59.6 million loss on classification of held for sale. Translating that, it means they're quietly dumping their entire cloud services business and taking a nearly $60 million haircut to do it. They're retreating from trying to provide the actual cloud equipment themselves and going all in on just being the landlord.
Which really begs the question, is management owning these results, or are they making excuses? To their credit, they're pretty transparent about this strategic pivot in the filing, but they're definitely relying heavily on the overall hype of the AI boom to justify their mountain of debt and that terrifying customer concentration. It's a total high-wire act.
Section 5, the bottom line. Let's bring all of this together. Applied Digital is a cash-incinerating hair. Yes, they are a high-growth infrastructure landlord with an incredible 1.2 gigawatt pipeline and durable scale advantages. But they're operating with an uncomfortably top-heavy tenant roster and a very heavy debt burden.
So, what exactly should you track when their next quarter's filing drops? 3 things. Number 1, customer diversification. Did they finally sign a 4th or 5th major tenant? Number 2, the cash burn rate. Are those day-to-day operating cash flows finally inching closer to positive territory? And number 3, progress on that 1.2 gigawatt facility. Any delays there could spell major trouble for their debt repayments.
Remember, this explainer was a translation, not a recommendation. Always pull up the original documents and verify the numbers for yourself on sec.gov if anything we covered today caught your eye.
Ultimately, the provocative question you have to ask yourself is this. In the great AI gold rush, is it safer to bet your money on the miners looking for gold or the landlord who's building the town? Thanks for being with us at the EDGAR Brief. We'll see you in the next filing.